Let's welcome in Cliff Corso. He is president and CIO of Advisors Asset Management. Cliff, if you had to say what maybe the biggest surprise was to you for this year, what would it be in terms of the market?
I would say where we had it wrong, and many did, was the expectation that the economy would slow down a lot more than it actually did. Obviously, we saw a reacceleration into the end of the year. That's quite a surprise, giving 500 basis points of rate increase. And I think we just underappreciated the cushion that the consumer had with excess savings and lower rates and locked into their mortgages at below 3%. So they had increasing borrowing. But we see fatigue on the horizon for 24.
The Federal Reserve, obviously, that had to be one of the biggest stories of the year, just this last month, or whatever you want to call it, pivot, flip-flop, whatever it may be. But as you will note, history also notes that sometimes when you think you got inflation beat, it rears its ugly head again. Do you think inflation is beat? And if so, or if not, how does that play into your interest rate prediction? Because interest rates do appear to be driving the equity market.
Yeah, this will be the third year in a row where the market's set up for expectation of a pretty aggressive pivot to lower rates. And I don't know that this third time will be a charm. I think here inflation, it depends on how you define beat. If getting to 2% means beat, the answer is no. We're still on the core level, almost 2x that level. And we've got a lot of dynamics going on in our view that'll make inflation stay sticky and make that so-called last mile a difficult challenge for the Fed. So, I'm a little bit surprised that the Fed was so dovish in the tilt, allowed the market to run the way it did, because if we're sitting here in the Fed and we're looking at optionality and game theory, why would we want this stealth easing going on when, again, history proves that inflation can come in waves, and we've got, again, a lot of dynamics here that make it sticky. So perhaps we're set up, again, for a third time, for the market to be disappointed in the expectation that the Fed might not move so quickly and so forcefully.
I guess the counter to that, Cliff, would be that history says that inflation can come in waves based on effectively one period of history, which is the 1970s, and they're confident that the downside momentum in inflation seems like it can be trusted for now. I guess also, the Fed itself is not projecting we get to target until more than a year from now. So it seems like there's leeway with short-term rates at 5 3/8 to maybe allow rates to ease back a little bit if you get at least incremental progress toward the target.
Yeah, I just think, Mike, that Powell, being a student of history, looking at the stop and start of the 70s, and yes, it's not a lot of data points there. I just think the risk of allowing, the risk that they missed the last time, they were talking about transitory, they were too late. To be too soon would be a double error here. And so I think, what's the rush? They have the ability to drop rates when they need to. And again, a lot of dynamics here, onshoring, reshoring. And we've got housing. You saw the numbers this week. Housing prices are heading back up because mortgage rates are about where we started the year, actually. Rates have now plummeted. The 10 years where it was when we sat here a year ago, the 2 years near where it was when we sat here 2 years ago. Again, I think it's just a little too early to drop the mic on inflation. And we're not talking 70s inflation, but 3%. And by the way, if it was stable and we all were comfortable that it was stable, that's okay too. So we'll see how the Fed plays this. If they really want to get it to 2%, again, I think that pivot that's priced in is just seemingly a little too aggressive for us.